Hi, I'm Greg Hunter. Welcome to USAWatchdog.com. With us a guest we haven't had on in a while. It's a great guest, very interesting person, two-time best-selling author. This is her latest best-selling book called All the President's Bankers. Appropriate time to have her on right now with the inauguration coming up. Her first best-selling book is called It Takes a Pillage. We're talking about Nomi Prins. Nomi Prins, thanks for joining us today on USAWatchdog.com.
Thank you, Greg.
Well, first of all, I want to talk about your next book, which I hope and probably will be a best-selling book, Artisans of Money. You've been teasing us about this and talking about this. I know you've been traveling around all over the world doing research on this book. Your books are super research. I mean, you got 100 and something pages of footnotes for your books. Well, the Artisans of Money, it's about the artisans, the central bankers who are the artisans. They put us in a big mess, basically. And that's about what your book's about. Explain your book. Give us a thumbnail of it.
Yeah, pretty much. Since the financial crisis happened, the Fed, of course, led particularly the G7 central banks into this chasm of fabrication of money, quantitative easing, stimulus between them with currency swaps, and various types of both on the surface and below the surface activities that had political undertones as well as financial undertones as well as impacts, not just on the market, but just on the entire infrastructure of the world. From a geopolitical basis. So we went from a financial crisis, from mishandling of it by the central banks and central bankers, to this disintegration of how the world looks in terms of superpower alignments, trade agreements, voting, and all sorts of other manifestations of the financial crisis not being handled properly by these entities. So the book really traces that throughout the world as things have unfolded, and things are continuing to unfold, which is why I'm busy. We're all busy watching not just what they've been doing, but what the ramifications have been. So hopefully I will put this all together in a global context, and it will be out in the fall.
Oh, good, great, fantastic! It's all the central bankers' fault, and that's all there's to it. I mean, the geopoliticals, all the parade leaders were the central bankers.
That they were in a way, and in a coordinated way that has never happened before. And that's really the key thing. The environment that we're in right now is not just because of one central bank. It's not just because of the Fed. It's because of the collaboration, the collusion of major central banks, of the developing market central banks, how China, the People's Bank of China, arose within that to fill their own space, the trade and financial agreements that have been offsets of those. So everything is traceable back to the financial crisis and how our central bank and then the other central banks dealt with it within their own countries and then connected to each other.
They're going to love you for this. They're just going to love you. Well, let's start with what's going on right now with Donald Trump, and I'm going to start with I think he's going to be successful, but there's going to be a side effect to success, and it's going to be some inflation. What do you think about the beginning of the first 100 days of the first year of Trump in office? What do you see for him?
Well, I think the first 100 days are going to be wobbly in terms of just a new president, the difference between what he has been saying during the campaign, who his cabinet will be in terms of the policies they will be able to enact, and what Congress will do in terms of the potential budget they will sign. Because a lot of what Trump has promised is predicated on raising money. It's predicated on issuing more debt, and we're already around the $20 trillion debt ceiling. So there's going to be congressional pushback. So I think what's going to happen is Trump's going to continue to, use Twitter and other sorts of sort of outspokenness, as he is very good at, to talk about small amounts of jobs being created along the way. Whether it's for bringing back a plant, whether it's Walmart hiring some more workers, whatever it might be, and sort of try to add those up as being related to his general job creation plan and his general job creation promises. But the reality of the larger infrastructure promises he's made requires funding by Congress, and Congress doesn't really move that fast, whether it's Republican or Democrat, and especially to issue money and to increase our debt. I think that's going to be having some pushback. So there's going to be volatility in the difference between what Trump has promised and what's going to occur, which is why also the dollar, which rallied not just on the back of him winning, but also the Fed raising rates by a little bit, by 25 basis points in December, and it's had a little bit of pushback since then, is going to also be in a bit of a volatile bind, because it's going to appreciate every time there is news about this potential growth, because of the problems that might occur going forward with inflation, which hasn't manifested yet, or because it might mean that the Fed is going to jump on board and raise rates more and more quickly. The reality is the economy is still weak. These things do take time. And the Fed, when it raised rates in 2015 in December, its forecast, all things considered, was for 4 rate increases in 2016. We only got 1. Now in 2016, when we got that 1 increase in December, they forecast 3, so less increases in interest rates. So I don't believe we're going to get more than another 25 basis point, maximum 50, but I believe 25 basis point rate increase this year, because the Fed's going to continue to watch what's happening in terms of actual, not just sort of spoken about growth, actual job creation, actual wages, and the actual economic stability on the ground. So that's going to create a little bit of volatility in the dollar. So I think the recipient of that will probably be the yen, as it usually has been in times of uncertainty and in times of a volatility bound around certain currencies. Gold will be a recipient of that, but not yet. It's going to take a little bit of time to see whether and how the promised policies jive with what's actually going to be enacted without argument or with particular funding in Congress.
So do you see the dollar going up or down? Do you see the pressure for the dollar in the up direction or the down direction?
I see for the first half of the year, as we look at what's manifesting in the first 100 days and beyond that, with both the Trump administration coming in, how Congress deals with that, and what the Fed will do after its rate hike of 2016. I see the dollar, on expectations of that going well, keeping a bit of a bid, staying within a range, but staying fairly up. But I think once the realization comes in that these things take more time than simply the promise, and the Fed will have to look at more issues of what's happening on the on-the-ground economy. And the global economy is very unstable. There's a lot of debt in the world that's denominated in dollars, and to the extent that the dollar either stays high or goes higher because of those growth promises occurring or because of the Fed hiking, it's going to create more problems throughout the world, and that's going to come back and haunt the U.S. So at that point, I see the dollar actually turning around and weakening towards the second half of the year. I said this last year, and it's sort of what happened. I think that pattern, for slightly different reasons, is going to reoccur this year, which is why in the next half of the year, it's when gold gets a bid. In the next half of the year, it's when the yen gets more of a bid, although I think the yen, because of problems in Europe, which will be related to their elections and general instabilities in terms of what happens with Brexit, a lot of these elections, which will be swinging away from EU support politicians to EU negative or opposition politicians, that's going to actually create a bid for the yen relative to the euro. So the yen's going to have a little bit more appreciation as a currency. The dollar is going to appreciate, but within a bit of volatility in the first half and decline in the second half. And gold's going to do the opposite, have a little bit of volatility in the beginning and then increase in the first half, because, again, of watching the difference between what is promised and what is expected versus what's likely to actually occur, given the inherent weakness, not just in our economy, but more so in economies throughout the world.
You think gold will increase at the end of the year, be volatile at the beginning and increase at the end of 17? Did I get that right?
The second half of 17.
The second half. And then interest rates, we had this big move up since October, then it's backed off some. Bill Gross says that, he's looking for 2.60, and it blows up, and it's at 2.3 for the 10-year Treasury. I know you were a managing director at Goldman Sachs, and you know all about this. So what about interest rates? Could they catch a bid and skyrocket? Could we lose control of the interest rate market?
Well, I think that pattern sort of follows what I was just talking about, which is that in this nearer period in the beginning, as we see the dollar sort of appreciate on the expectations of Trump's plan possibly working, but then decelerating on the actuality of it taking longer than the promises would indicate, as well as the Fed having promised they might raise interest rates, but again with less less of a fortified promise than they had the year before. Again, they had promised 4 or expected 4 rate hikes for 2016. We got 1. They expect 3 for 2017. If we only get 1 or even 2, that's not going to ultimately create the same height in rates for the 10-year, for the longer-term treasuries, as we've seen that pattern go right now on expectations that there will be a rate hike and expectations of that growth and expectations of inflation. So right now we have seen yields go up. They could go up to 2.4, they could go up to 2.5, but the reality is they're going to be contained at a point at which the reality of these promises meets the practicality of how they get translated, both with respect to Trump and with respect to the Fed. And again, in the backdrop of a very weak global economy where the U.S. cannot, for its own sake, as well as its status within the global community, because it does trade, whether these are good trade partnerships or bad trade partnerships, whether they're renegotiated or not, it does trade with the rest of the world. And so the health of the rest of the world, the health of the rest of the world's banks, which is related to the health of the rest of the world and debt in the rest of the world, matters. And I think ultimately there is still a lot of weakness and a lot of instability. And so if there's too high a rise in rates here, if there's too high a rise in the dollar, if there is too much growth too fast when it's not practical, it's just based on sort of promises, I think that's going to retract. So again, we could see yields, just like we could see the dollar, increase towards the beginning of this process, but come back down as bonds appreciate, as the dollar comes down, and on the reality that these expectations don't necessarily match what's happening on the ground economically and in the world.
What's the wild card here? Is it China? Is it the Middle East? What's your fear factor?
Well, I think what's going to be the most interesting is what happens with the U.S. relative to sort of the Russia and China dynamic. So right now, and what's happened in the last few years, and it actually started with the financial crisis, but China has really taken a leadership role in its own region in terms of issuing loans for infrastructure development within, throughout the Asian area, also in Latin America, through eventually and ultimately getting the REN into the IMF's SDR basket on October 1st of 2016, to all sorts of both bilateral, trilateral trade agreements with countries like Russia, with an agreement that they're negotiating right now with Japan, which has been a historic enemy and with which there's military issues related to the South China Sea and islands there. But on an economic basis, they are negotiating, forging partnerships, and with South Korea. So China's been doing all of that. China's also had a weakening in its economy because of this overextension, but relative to the U.S., relative to Europe, the weakening of its economy is still a relative strength in the region and to the rest of the world. So I think that continues. But the U.S. also, under Trump, and this wasn't just Trump, I mean, this started under the last administration. It's been a particular sort of thorn in the U.S.'s side is how China reacts in terms of its currency, whether it's a currency manipulator, whether it's labeled as a currency manipulator. During the Obama administration, both Tim Geithner and Jack Lew, the Treasury secretaries, stopped short of labeling it a currency manipulator, but in many G7 and G20 meetings, they said they were watching China. And when the REN came into the SDR, Jack Lew basically said, look, this doesn't make you a superpower, it's just a step. You need to open your markets, you need capital reforms, you need this whole long list of things the U.S. wants you to do. Now, I think Trump is going to want them to do the same thing. He's also talked about this idea that China is a currency manipulator. The reality is all central banks manipulate their currencies, which you will, I think, know, a lot of your viewers know.
Amen to that.
I will delineate this in my book. I mean, that they all do it, and they all do it for their own national reasons and also certain bilateral reasons and regional reasons. That's just part of who they are. But in the recent sort of cycle of that, the People's Bank of China has actually witnessed capital outflows, and that has been the main reason at the moment that the currency has been devaluing as opposed to actually changing anything in terms of its boundaries. So that's what's been happening now. But I think if we ratchet up that rhetoric, and if we, as the United States under Trump ratchets that up, that's going to create more tension with China. It's going to cause China to look more at these relationships, at the one China type of arrangements that it's looking in, that it's involved in, and actually become even stronger, but potentially in a more tense way rather than in a negotiated way in the region, and that could create more tension relative to the U.S. But in terms of Russia, that's kind of a separate thing, because on the outside, Russia's, it's been strengthening. It was the ruble was one of the key appreciated currencies last year. It led, it increased by about 21% versus the dollar last year. It led the emerging developing markets in terms of that appreciation. Its stock indices rallied significantly. Its major stock index, the MySex, rallied 24% last year. I mean, it had a significant showing, even with our election, all the talk coming out of the U.S., particularly from the Hillary campaign, about how Russia's sort of, the devil incarnate. The reality is their economy has been improving. It's been improving for a couple of reasons, one of which is the instability in Europe. The instability in Europe, which I think is the wild card. So it's a long answer, but these things are all interrelated. The instability in Europe has caused a lot of the Eastern European countries to vote out politicians who have been more pro-EU and vote in politicians who have been less pro-EU or anti-EU and more pro-Russia. And so that's not just a political statement. That's the citizens saying we don't like what we have. We're concerned with our own economic stability and how this has gone down, and our leaders and all of that, which is why people vote for change. Often it's not linear, but a lot of it, I think, relates to economic instability at its core. And they are looking towards Russia. That has allowed Russia to negotiate more agreements, to do more business with its old partners. And also, I think that will continue as we see more elections coming through this year in Europe. There'll be core European elections. Holland has an election in March. France has an election in May. Germany has an election in October, which could be moved up to August. There's a lot of things in flux in Europe. All of those benefit, if it continues to go the direction it's been going in, starting from Brexit and through Europe, it's going to benefit Russia. On the other side,
we'll stop just for a minute. If Le Pen wins, the EU's over, is it not?
If the pen, first of all, the euro gets smashed. I mean, as it's been. I mean, that's the currency to sort of sell. But if Le Pen wins, and it was interesting. I was in Berlin actually just a couple weeks ago, just before the holidays, and I was talking about this with a bunch of German politicians in terms of what that could look like. Because also in Germany, there's a lot of movement away from sort of the Merkel government and away from that party in terms of its current politicians and into this sort of anti-EU type of set. And the interesting thing about France and Le Pen is that at the moment she only has about a 20%, 22% sort of voting proportion. But that said, Brexit was lower than the percentage it ultimately wound up at. Trump was lower when he was one of many GOP candidates. I mean, there was always this conversation as he was sort of beating out the rest of the GOP field as to whether or not he could sort of accumulate enough to win, and he did. So I think the same thing is happening in France. It's happening more so in Holland. So what's going to happen is the Dutch vote is really going to be key to the French vote, and the Dutch vote's the vote to watch.
That's Geert Wilders.
Wilders in March, and that's going to be the thing to watch, because that will be a big predictor, as was Brexit, to what could be the Netherlands vote, to what happens in France. If that happens, yes, it doesn't mean the end of the EU, at that second, but it does create a tremendous additional weakening on the whole bloc, on the bloc politically, and on all sorts of new trade negotiations that would be happening, in particular with how Brexit is negotiated relative to the EU, and the continued votes that happen throughout the year. And the result of all of that will initially be a very deteriorated euro, no matter how it goes down ultimately. Whether the EU disintegrates or whether it becomes this ongoing multi-year, which is very likely battle, just creates more volatility and instability within Europe. And it's already very tense on the ground there. So then going back to Europe, to Russia's all benefits. Russia was also having these side conversations, has had agreements made with China, because Russia, Putin's very smart. He's not just waiting to see what happens with Trump and with the U.S. There's been very favorable rhetoric so far, but that could be a wild card. I mean, things could change. Somebody could get annoyed at someone else. So what he's been doing is fortifying his relationships with Eastern Europe, his relationships with the U.K., his relationship with Japan, and in particular his relationship with China, and the non-Russia BRICS countries. So all of this is in flux right now. So the wild card will be how we ultimately, I think, use Trump's political position to deal with Russia and China, and perhaps not realizing that Russia and China are also collaborating with each other, and that triangle is an important thing to look at, because a break in that could could create a major rift in general. It could create a military rift, an economic rift, a financial rift, and just general instability.
So the biggest wild card is Donald Trump.
The biggest wild card is, I think it's a combination. It's Trump is a wild card, but again, so is Europe and where it faces. I mean, right now the political sort of lens goes over to Europe as you know, caught between its old and its potentially new structure, its old and its potentially new political leadership. So I think that's the major wild card now, and that snakes through Russia, that snakes through the Eurasian relationships. That relates back to Trump. The wild card is the linkages amongst those things.
And do you think that that there's a clear-cut bad guy and a good guy? You were telling me this in the pre-interviews. Well, the problem is there's no good and bad guy. I mean, everybody's got side deals. So explain that.
Well, from an economic standpoint, everyone has side deals. So there's no sort of positive or negative economy. We can look at China again as deteriorating, but that doesn't make its economy necessarily weak. It just means it's dealt with its economy in a slightly different way. You have a situation there where the People's Bank of China, their central bank, and the government are very tightly connected, and they do policy together relative to, you know, sort of its old nemesis, but current potential and growing partner Japan, wherein there was an independence between the Bank of Japan and the government until Abe got in power and Kuroda's in power, and now they're sort of moving lockstep, but it's not clear whether the policies that have been adopted are effective for the middle class, are effective for people on the ground. So even though Japan is sort of a neutrally kind of world in and of its own, when you're on the ground there, you know, people are beginning to feel their own economic pressures. So there's positive and negative in that. There's positive and negatives with how it deals with China. There's positive and negatives with Russia, you know, in terms of how you know, Putin's been characterized, how he's characterized throughout the elections, the sort of polarization of, you know, how Hillary Clinton was talking about Russia with how Trump was talking about Russia. I think in both those situations, the Clinton camp went towards painting Russia as more of an enemy than it should be painted as, and Trump more of a friend than it might be painted as. And the reality is, it's a separate country dealing with its own internal flux, its own internal economy, as well as external relationships. And so there is no real, you know, all countries do good things and all countries do bad things. But what's happening right now is all of the alignments between countries have been changing. The idea of Trump coming in, and as he did in his businesses, creating bilateral trade agreements, as he's talked about most recently with the UK, but that's just how he's sort of positioned himself. You know, whether you call it isolationist or you call it bilateral agreements, the reality is there's a lot of renegotiation that's going to be happening, but it's not just the US and Trump renegotiating. All the other countries are negotiating with each other as well. So that's why you see this shift. And if there's enough antagonism to how, let's say, a Trump administration negotiates those trade agreements, he says they're going to be good for both sides, but yeah, every country again has to look at its own scenarios, and then they start negotiating with each other. That could limit trade into the U.S. That could limit our bargaining power. It could increase various bargaining power and trade arrangements between other countries that are completely separate from the United States. That's all in flux this year.
Handicap a crash for us. You know, Catherine Austin Fitts said there wouldn't be a crash in 16. So did Charles Nenner. I believe you weren't really keen on a crash either. So what say you now in 2017? Fitts and Nenner both say something bad is coming our way in 17. What do you say?
Yeah, so I mean, as you said, in 16, I pegged the non-crash and the extension.
That's
on
right, you did.
And that was because, and we saw extra manifestations of, I call it artisanal money creation relative to my book, and just the artisanal money people being the central bankers, finding just new ways to extend their money creation policies. And that's what kept the markets up. There was a separate bid on the markets that kept them up after Trump was elected, on the expectations that he would be good for growth, that he would create infrastructure, that he would create jobs. And again, the jury still needs to be out on that and how it relates to Congress and what we discussed in the beginning of this. But I do think there is some there's a little juice left in these central banks. I mean, I keep thinking that there shouldn't be. I've thought this for years, but they keep surprising all of us, I think, with their ability to boost the markets, to artificially basically stimulate so many different asset bubbles, whether that's in debt, which is epic, or in all the stock markets, many of which are at their historic highs. So there's room to go down, but there's also a little bit of room for the central banks to continue to manipulate. And I think for 2017, that's going to be the story. If we have a crash in 2017, again, it's going to be in that second half of the year after these promises. The rate hikes, the dollar being high, just collapse into the realities of instability and this artificialness, and the central banks don't have much room to go. That is going to hinge not just what happens globally, but particularly what happens in Europe. The ECB has now extended and it was the catalyst that I thought would create more of stability and less of a crash last year. It has now increased its purchase program through the end of 2017. So if I look at the trend of the ECB, just as one central bank example of a very artificial stimulator, we could see volatility to the downside, not necessarily a crash into the fall of 2017. And that will be after the elections happen. If they really do go anti-Europe, if the last election in October is sort of a very anti-current German leadership vote, that's going to basically create an out-of-steam situation with the ECB. Other things could happen with other countries, like, as I mentioned, Russia, China, and so forth, between now and then. So I think, and I'm a little less sure about this crash this year, I got to say. I think if we see a real big decline, it's going to be around that time. It's going to be towards, again, the end of the year, but not the second half, but the last quarter. That's when I see it happening. But I really just see a sort of downward trend into that. I don't see it necessarily as a crash. I just see us staying in a range through the first half of the year, and then as these elections, as these arrangements, as the realities of what's happening versus what was promised come into effect, I think we start seeing more of a decline in the second half. And depending on what happens in Europe, most particularly with Germany in October, we could see a crash in the final couple of months. That's where I'm at right now. I'm looking at all of these factors as they interrelate and what potential juice. And at this point, it's primarily ECB, maybe a little bit the People's Bank of China, but they've sort of stepped off the pedal of their version of quantitative easing. And I think Japan's pretty much done. So there's a little bit of juice left. The Fed could come in. They've got 50 basis points of room to work with and reduce rates if they really needed to. There's just a little bit of juice there. So I take it as looking, again, towards the end of the year and for those factors.
Nomi Prins, the best-selling author of this book. This is her latest book, All the President's Bankers. Her next book coming out is The Artisans of Money. Nomi Prins, thanks for joining us today on USAWatchdog.com.
Thank you, Greg.